Welcome. We are going to now wrap up the session on global valuation. Have I covered everything? No. Have I covered enough for you to get started and try to take this journey? I believe yes. I've used numbers. I've tried to make it interesting. But sometimes you have to use frameworks, and I wanted to spend some time on parity conditions, which, by the way, I hope you found exciting, regardless of the use here. So what are the major takeaways? What are the basic assumptions or best practices did you learn? And please think about it, and I will give you my view of it. I think the basic assumptions we learned is valuation fundamentals do not change just because you go from one country to the other. Of course, that's true. In more pure form, the more integrated the markets are. But if they're completely unintegrated, then there's no point talking about this topic, right? What are the best practices we learned? I think the best practice I learned in studying financial valuation across boundaries, and I'll share it with you, is that be very careful not to guess. So if you are thinking you know exchange rates, and I've said it before, don't mix your knowledge of exchange rates with the project valuation. That's not fair. If you're a manager of a person doing an analysis, judge them on their assumptions. Don't judge them on what happens after the fact. Okay, that's not fair, because nobody knows what's going to happen in the future, and that's why the best practice is arm's length market data, and that's why I love markets. Markets are just the guesses of multiple people, that's all, and they're better on average than the multiple guesses. Once in a while we all get confused, but still the market should be less confused than all of us individually. Anyway, can we do better than what we did? How? So remember, you could do better if you had forward rates available for up to the future, but there's a disadvantage in that you don't have forward rates available. What we did a little bit wrong was, remember, 1.12 over 1.05 we used for all years. And I think that's in textbooks, many people just go with it. I think you could do better than that. Why? Because you could have, this is a 1 year ratio. It's easy to find 2-year bonds, and I bet their ratio is not the same. Why? Because if I took this ratio and applied it to 3 years, but it was actually a 10-year project or a 20-year project, I'm killing one currency. One currency is depreciating over time. And which one is it? Thai baht. That's not realistic, right? There's something called regression or convergence to equilibrium. So what you want to do is you want to build in expectations of the future based on market data. So use a 2-year to figure out for a 2-year. Then there is a 3-year. In America, you have bonds up to 30 years in the future. So you could do very sophisticated analysis by matching, like we did. Remember, how did we get the discount rate for the project in Thailand? By matching the risk. We didn't take the 5% from America and match it with the Thai. We took the 15%. Similarly, you can use that matching for bonds available in different countries, right? So I would do that. The other thing we didn't talk about is the discount rate. Till now we have assumed, before we did global finance, the discount rate is used in a way where you just use CAPM, and I must say I do use capital asset pricing model with beta and the risk-free rate a lot, but you can do much better because it has some shortcomings. It's simple model, it's awesome model, but it doesn't capture everything, right? So home country discount rate, I put it up, is from CAPM, where if you see you have expected return and you have risk-free rate in the home country, plus you have the expected market and beta I. So if you're sitting just in your home country, I would encourage you to think about this equation. However, you can do better now. Why? Because we are a globally traded, integrated. You could do an international version of CAPM. And I'm throwing up an equation, and I'll let you kind of stare at it. As you know, I don't believe in handing out notes, because I think they come in the way. But sometimes the equations are complicated enough that I don't want to write them by hand. So here, what is the change? This component typically is related to how the cash flows are correlated with the exchange rate. And we assume this correlation is close to zero. The return on equity's relationship with cash flows and the foreign exchange changes, that systematic part most of the time is assumed to be zero. But let's focus on this one. What is RM here? I would ideally use the world market now. So the beta you'll use is sensitivity with respect to world market. So when you're doing this analysis, I encourage people, and whenever I do cases and so on, is think carefully. Use a market data, because a lot of companies are global now. Get a beta for the world sensitivity. And the reason you do that is you don't have to be a global company. If your investor is globally diversified, and even if a few of them are, and they can trade, it makes a lot of sense to use global market indices, and they are available, right? So use that data to figure out your beta. Again, this is one place where I would go to Morningstar, or I would go to a professional company that does estimation of beta well. But there is an international version of CAPM, and that's one way to go. The last term, as I said, is the exchange rate. We assumed it to be zero. I've talked about market return and market risk premiums. How would you look at them? A couple of more big picture items. Whenever you go to another country, suddenly people start worrying about country-specific risks. And when you ask them, what are you worried about? I think typically these kind of suspects come in mind. Political risk. So what does it mean? Maybe what will happen is there'll be some political problem between the two countries involved, and that will affect the cash flows of the company, right? Or risk of expropriation. What does expropriation mean? It is the outcome of typically political risk, which is, worst case, I'm just going to take away all your assets and you can't do anything about it. You being US and this country being Thailand, or in the reverse order, right? That risk. Then risk of devaluation is always on the mind. My advice here, and this is not my advice, this is the advice of thoughtful people, is that in the real world, these are all true. The question is, how do you deal with them? This forum, at least the video forum, one-on-one kind of conversation, I always hope you feel like I'm connected to you, is the downside is it needs some engagement to talk about issues like this. So I'll leave you with some thoughts about such. How do companies deal with these risks in valuing global opportunities? I think what they tend to do is, and this is very common, that doesn't mean everybody does this, they tend to increase the discount rate. And I think that's a dangerous thing to do, because it's a knee-jerk reaction to something you feel uncertain about. So the example I gave is, I'm in Ann Arbor, and suppose I open up a factory in a state I know nothing about in the US. I feel uncertain and I increase the discount rate. If I go to Thailand, I feel even more uncertain, I increase the discount rate. After that, what happens is, it's an unintelligent and not very thoughtful way of dealing with the risk, because the extreme cases, you won't go anywhere, right? So how do you deal with it? I think the intelligent way, and I spend a lot of time in real-time classes, is they should deal with it by modeling the cash flows. And I use a methodology, just thinking-wise, which is called option pricing, which kind of makes you think about volatility in what you're doing. And that's the approach to take it. Modeling your cash flows in the future and incorporating risks there. Because if you jack up the discount rate, the danger is you're blindly hitting cash flows and discounting them with compounding without thinking through why you're doing that. So that's a big piece of advice I leave you. This is one place where I think practice is very important. And please reach out to other sources. Think about it. But the takeaway is, I tease this and I say, MC Hammer had a famous song, Can't Touch This. So I would say, think 100 times before you touch the discount rate based on market data. Yes, adjust it based on the inadequacies of CAPM and so on, but use market data and don't start manipulating the discount rate. Finally, some final thoughts. Do not second guess market data. Think APV approach. What do I mean by that? Countries are different in many ways. One of the ways is tax regimes are different. Repatriation laws are different. Market frictions may exist in exchange rates. So what do I mean by use APV? What I mean is the following. APV's approach is to take VU, value unlevered. And that's, I think, what we tried to do here. We didn't worry about anything about leverage and taxes and so on. And then add the tax shield benefit of debt. For this, you should have been exposed to valuation methods, right? So I'm presumptuous here that you know that. Add them, any tax benefits like the tax shield of debt, interest tax. Subtract any bankruptcy cost related stuff, any agency cost related problems with debt. But similarly, suppose, let's take a very stark example. You're going to Thailand simply because the tax policy there is friendly. I'm being very upfront. I don't know that for sure, but chances are very high that the benefit you're getting due to the differences in tax regimes, or because laws of sending back money give you an opportunity to make money, right? Add them to this. And the reason is then you'll be able to see where value is being generated. It was fun doing this. As I say, it is fun always taking finance to places where people thought it couldn't be used, using the fundamental same framework. May the force be with you. See you soon.